Hello, everyone. Annie Dickerson here, and together with the fabulous Julie Lamb, we wanted to welcome you to another episode of the Life and Money Show, where we do our best to keep you in the loop on all things related to life and money. With that, let's go ahead and dive into our conversation today around interest rates. All right, and I mentioned in particularly we want to make sure that you're educated as an investor about not just, the economics of what's going on in the financial landscape in terms of interest rates, but also what they mean for you as a passive investor. But we are going to start with a little bit of background. So let's start with the recent, the quarter point increase, the 0.25% increase or 25 basis points that the Fed announced just last week as of this recording. So what this means is that the Fed raised rates by those 25 basis points, and that brings the target range currently up to 4.5 to 4.75%, which is fairly high, relatively speaking. Certainly not as high as it was back in the 1980s when it was up in the 18%, 20% range. But we haven't seen rates at this level, the 4.5%-ish level, since October 2007. So it's been a number of years. And funny enough, October 2007 was when my husband and I got married. So for as long as we've been married, interest rates have been lower than that. Isn't that funny? Why does the Fed continue to raise rates? In fact, they've raised rates several times since March of 2022. And the reason that they continue to raise rates is in an effort to curb inflation. I'm sure you've seen the price of many, many things go up over the last year or so. And so what the Fed is trying to do is they're trying to slow that down. They're trying to make sure that things stay at a relatively affordable level. And so how does this happen? So when the Fed raises rates, the goal is to increase the cost of credit throughout the economy. Now, I'm going to speak slowly at certain points because I'm not an economic buff. Economics. Yeah, that's the word I'm looking for. And I'm not an economics buff. I didn't major in economics in college. So I am learning this right alongside of all of you. And I know sometimes it can take a moment to process some of this. So I'm going to say that again. When the Fed raises rates, the goal is to increase the cost of credit throughout the economy. A rising interest rate makes loans more expensive for both businesses and consumers, and that includes mortgage rates. So what happens is everybody has to pay a little bit more for their interest payments. And as a result, those who can't or don't want to pay the higher interest rates, well, what do? They may choose to postpone. Those people who are looking to buy a house, they might say, well, maybe we'll just continue renting for a little bit longer. Or they may walk away from projects altogether that might involve financing. Now, at the same time, this encourages people to save more money because they're earning higher interest on the money that they're saving. And in addition, housing prices may even slow, and we're starting to see some of that because fewer people are buying, and so the demand is starting to go down. Not across the board. There's certainly parts of the country where demand is still high, but also parts where that demand is leveling off because those mortgage rates are rising. So this in turn, see, there's a whole sequence of events. So the Fed does one thing and then 10 things happen as a consequence, right? So this in turn reduces the supply of money in circulation, which tends to lower inflation and moderate economic activity, which helps to cool things down. So again, it reduces the supply of money in circulation because, again, people are saving more money. They're not spending their money because prices are going up. Interest rates are going up. So instead of going out and spending, they're holding on to their money. And that's what helps to curb inflation. So all that being said, when the rates are on the rise, it is more crucial than ever to find good operators to invest with. With the appreciation cycle after the 2020 pandemic, investment groups could get away with buying something that was maybe a little too expensive. There was incredible market velocity, which, as you know, means, there's a ton of appreciation. But in today's market, today's financial landscape, things have shifted. And so you can't get away with that anymore. And so today, no one can or should hope for appreciation. You shouldn't expect it. And so you've got to find operators that underwrite conservatively and under-promise so that they can over-deliver. What you don't want is people still promising you returns that you may have seen, 3, 4, 5 years ago. It's very, very unlikely unless they are fiddling around with some of the numbers behind the scenes. So just some food for thought as you're considering potential investments, which we'll get to as to whether or not it's a good time to invest. Now, let's talk a little bit further about, what can a multifamily operator do in this market right now? Well, it can be hard to make any deal look incredibly appealing in a high interest rate real estate market, but there are a few ways to reduce the uncertainty behind changing interest rates when obtaining debt for a real estate deal. Now, the most important thing for any operator should always be preserving their investors' capital and not rushing into any deal just to do a deal. Deals must be scrutinized now more carefully, especially in the current high interest or higher interest rate environment that we're in. And so you as an investor certainly don't want to work with a team that tweaks the numbers just to make a deal look good. And so the onus is going to be a little bit more on you in this environment to do your due diligence and really ask those tough questions and get to the heart of it. Don't just, take everything as it is, but take everything with a grain of salt and really dig in and understand and get comfortable with the assumptions that are being made on the deal so that when you invest, you can be sure that there's ample buffer built into the deal, and there's lower risk in this higher interest rate environment. All right, so let's talk about the different types of debt, because this is key, especially when you're considering investing in this environment, to ask those questions about what kind of debt are you getting on this deal. And so let's talk about a few different options. Now, first, sort of the gold standard is fixed interest rates. In other words, those interest rates that are basically set in stone. Doesn't matter how much more the Fed raises rates, that fixed interest rate is locked in. So fixed rate debt means that the interest rate quoted will remain the same for a specified duration of time. So like I just said, no matter how much the Fed decides to raise rates in the coming months, a fixed rate loan means that it will be protected against all of those ups and downs. Now, in this market, it is still possible to find fixed rate debt over longer periods of time, especially such as a 7-year term. Banks and lenders mitigate their risk, mainly the risk of interest rates rising and thus missing out on higher interest rates payments, by offering fixed rate debt at a little higher. The numbers are a little bit higher. For instance, these rates are sometimes at, let's say, 6 to 7%, which is roughly double what they were just a year ago when the Fed began raising the base rate. And so for fixed rate debt, it's a trade-off, right? Because banks and lenders are trying to lower their risks. They're foreseeing that maybe the rate will continue to go up. So they're hedging their bets and setting that rate a little bit higher. The downside to this is that disincentives are included to encourage borrowers, which is us as the investors and the operator, from selling early and paying off the loan balance. So for example, if we sign off on a loan with a longer term, let's say 7 to 10 years, and then we sell in a shorter term, let's say 5 years, there's typically a substantial fee for that. And again, banks, I get it, right? They're not in here for the good, doing this for the goodness, just for the goodness of their hearts either. They're trying to make money too. They're trying to keep the lights on and make money as well. So they have to hedge their risk as well. And that's why they build in things like the higher interest rates, the longer terms, and the prepayment penalties. So that's fixed rate. So that's, that can be a really good solution in this fluctuating interest rate environment. But, it does come with some downsides to consider.